Welcome back to Smart Money on CNBC-TV18. Very exciting topic. I mean, it's perhaps, old wine packaged in a new bottle, but these are investment products that you need to have in your portfolio. And if you don't, Anand Dalmia is here to tell us about that. Anand, before the break, we were talking about a couple of products, right? Whether it's mutual funds, direct equity, or the NPS scheme, National Pension Scheme. Tell us a little bit about corporate fixed deposits and bonds as an investment product, because this is a space which a lot of people don't understand. But now with the way interest rates are rising, what is the potential here?
Look, I would say, this is a great time to invest in any debt product. And within the debt product category, there are two types of risk. There's a liquidity risk and there's a credit risk. The credit risk is basically if you invest in something and you don't get it back. That's the reason we like fixed deposits of banks. Now, fixed deposit of banks generally give you a certain deposit rate. Now, if you take a bond, for example, central government, state governments, companies issue bonds. Now, if you buy a bond of a credible company, company is suppose something backed like by a state government, and you make a 8 to 9% on that for 2 years, we all know that interest rate is peaking out. It's a matter of time when the cycle turns around. So you get both the coupon plus the upside because now the interest rate comes down. So we believe that if someone is holding on to a good bond for the next 3 years, he can end up making 12 to 13% returns because it's a coupon. Plus, when the interest rate goes down, the prices of the bonds actually go up. So it's a great time to invest in good bonds. We generally suggest central government and state government bonds because the credit risk is not there. On the corporate FD side, it's again, if you can find AA plus or AAA rated corporate FDs.
Some examples?
Your Bajaj, or Shriram Transport. People have invested in the FDs over a period of time. They have a track record. And when you invest in these FDs, you tend to make 1% more than some of the FDs offered by banks. Today, you have a few small finance banks that offer you better FD returns. But if you're not too comfortable, you can go till 5 lakhs because till 5 lakhs, you have the insurance on that. So depending on your tenure, if your tenure is less than, say, 3 years, you should not invest in equities.
So you're saying that if you have a certain amount that you want to not invest in equities, rather than parking them in fixed deposits, you'd rather put them in corporate FDs?
You can put a part of it because, again, when you start doing it from on a day, if you're all FDs, you should not shift everything on a day. But a part of it, you can put it in corporate FDs to make higher returns. Again, go after the quality. Because sometimes, there are corporate FDs that you can make 12% returns. But the reason they're giving you 12% is there's a risk associated with it.
Absolutely. So you said Bajaj Finance, there's Shriram Transport, and which else?
Chola,
Chola.
So some of these guys, Sundaram also has a decent corporate fixed deposit.
And what returns do they give you over, say, a year?
Generally in the range of 8.5 to 9.5. So that's the range. And I think, there's a good track record for these NBFCs. And, and they've been deposit taking NBFCs for a period of time. They've not defaulted. So someone can look at these. Within that, we like Bajaj the most. I think it's the most stable company. But I would personally say if someone has access to bonds, because generally you need a minimum 10 lakh rupees check to have access to these bonds, the bonds market. So if you can do that, today bonds can probably give you the highest returns, given that, we believe that we are somewhere around the peak of the interest rate cycle.
Okay, that's very well explained. Lastly, the focus is on insurance as an investment product. Now, we can do a whole half hour on this, but just to crystallize it for us, term insurance is one thing, then medical insurance is the other. But, for someone who perhaps has not started their journey yet and not invested in insurance, what are the first 1 or 2 steps that need to take?
Look, as a principle, we don't think insurance is an investment product.
Absolutely.
Go for a mutual fund or go for a bond and take a term insurance. But, there's a tax element there. So, as you know, in the recent budget, if you invest more than 5 lakhs in an investment insurance product, it becomes taxable. But since you're just starting out, and because insurance returns are tax-free till 5 lakhs, starting this financial year, I would say someone can look at an assured return product. So the likes of HDFC, ICICI, all these providers have an assured return product. I would say someone should do that. But again, try and not mix insurance and investment. I would say go for a term insurance and look at the right investment product. You'll make a lot more money. But if you want to have that assurance and ride the tax benefit, go for a assured return product.
Okay, we're getting a lot of queries from our viewers. So we've tried to sort of put together a couple of them. The first query will come up for you on your screen in a bit. It's coming in from Varun Vedya. He says, can we expect a 9 to 10% returns from equities this year, Or is it a better option to opt for fixed deposits, which are giving us 7% plus risk-free returns? So this is equities versus fixed deposit. But of course, that 7% plus, you need to calculate that post-tax returns are much less than that. So what's your view here?
Look, it is, again, for a one-year period, I don't think equities is a good product anyways, because while India over a period of time, I believe for the next 5 years, one can assume 12% plus returns. It's very difficult for anyone to predict what will happen between now and 31st March of next year. So if your tenure is just that period, I would say don't touch equities, go for FDs. But if you are looking at a rolling return, saying that, okay, can I make 12% rolling return if I invest today? Absolutely. Go for equities if you have a slightly longer tenure.
Longer horizon. But even within FDs, right? I mean, 7%, you have to pay tax on that. So it's better to go in for corporate FDs in that case.
So I would say corporate FDs or arbitrage funds. We believe that, look, if you have money for 3 months, 6 months, today you can put in arbitrage funds, because arbitrage funds are treated as equity funds. So you make a long-term capital gains on that or a short-term capital gains on that if you hold it for less than a year. And if your tax rate is 40% or 30%, you will make a lot more money in arbitrage fund than a corporate FD as well.
Okay, got it. Well, there's another query that's coming in, so I'll just request my director to get it on board in a bit. It's from Nilesh Khandelwal. He writes into us, does it make sense to invest in corporate bonds or Government of India bonds as advantage of mutual fund taxation is no more available?
Actually, I believe in this. We were just discussing this. Mutual funds earlier were more attractive just because of the indexation benefit and the taxation status to it. Today, given that that's gone, I would say it's much better to invest in a corporate bond or a government bond. And as I said, given where we are in an interest rate cycle, I think you can have a double upside. One is the coupon, plus the benefit that will accrue to you if interest rates were to come down, which looks from the cycle and the long-term yield curve that it should come down.
Okay, and if you have, say, 100 rupees, right, what is the split between mutual funds and corporate bonds?
I would say it depends on your asset allocation. Generally we say 100 minus your age should be your asset allocation as a rule of thumb. So if you have 100 rupees and you are 40 years old, then 60% equities, 40% debt. So it should be equities and 40% in corporate bonds. Again, it depends on, for how long your money is there. So if you have this money for less than 3 years, then 100% corporate bonds and no equities.
Okay, there's another query that's coming in. I don't know if we have it on board, but it's, okay, there it is. Manthan Kashyap has written to us, what's your view on liqui loan products? It's backed by the RBI and giving returns in the range of 8 to 10.5% for a tenure of 1 to 3 years. There is another query that had come in on P2P lending platforms like Cred that are offering 9% per annum. So this is, I guess, liqui loan products are more about like P2P products, right?
Absolutely.
These are pretty risky in my opinion, but your thoughts?
Look, it is, I would say, if your risk profile is that high, go for equity. It's as simple as that, because in your P2P lending, you don't know the other party at all. You don't know the counterparty risk. You are basically assuming that, okay, a lot of people are there and maybe I get my money back. So I keep saying that, look, if you have the risk appetite, go for equity rather than debt, because your upside is limited, but your downside is unlimited. So might as well go for equity.
So basically the P2P lending is non-secured lending, right? It is to small ticket borrowers. There's a large pool of borrowers with unsecured loans. So it is in essence a very, very risky product.
It is.
Then why does it generate so much interest?
It just generates interest because, the people on both sides are actually individuals. One who has money, he believes that if I give it in a fixed deposit, I make 7%. But, there is a guy who's taking a credit card loan at 36%. He comes and takes at 15%. You basically, lend it to someone at 15%. But the point that we're missing is that, look, if that guy defaults, you feel that I'm now lending to multiple people. So people have said that, okay, your loan or your investment is across 100 loans. But what if 50 go bad? So you have no visibility into it. I think some of these platforms are doing a good job of using analytics. But at the end of the day, it's a very risky product.
Okay, guys, P2P lending is a very risky product, so don't even take a chance with it. And finally, let's end with gold, because this week gold hit an all-time high of 61,400, and there's so much FOMO. A lot of investors have written to me. Is it still good to buy gold, or have we missed the bus?
Look, given the volatility in the market, the macroeconomic situation, I think gold should be a part of your portfolio at all points of time. Generally, we recommend 10 to 15% of your portfolio should be gold. Within gold, today the best product is probably the sovereign gold bonds. So if you can buy that and make that 10% of your portfolio, it's great. If it's already there, I don't think, I would say you missed the bus, because, I don't think it's going to give the same returns for the next few years. On a rolling return basis, gold has not beaten equities in the last 10 years.
Okay, well, on that note, Anand, thank you so much for stopping by and speaking to us about the products one needs to look at. Of course, these are concepts that perhaps everyone knows, but there's no harm in revisiting classic concepts to help you with, your building your corpus. With that, it's a wrap on this special edition of Smart Money. Thanks a lot for watching. You can keep writing to us. See you again next week.